So I have a lot of other videos that talk about why do a captive, but I've gotten a few questions. How do you structure a typical captive insurance company? So in this video, what I'm going to cover is how the majority of our clients structure their captive insurance companies. Hi, my name is Wes Sirk. I'm the president of Risk Management Advisors, a risk strategies company. Thank you for tuning in. So in many of our other videos, I've said, why do a captive? These are the benefits of doing a captive. I even did one recently, why not to do a captive insurance company? But what I never covered, I realized because I had a few questions, is what is a typical captive insurance company design? It's very simple. We went through what is a captive. It's an insurance company that a business sets up to insure its own risk. So the typical captive insurance company design is a C Corp or an LLC taxed as a C Corp. Now it has to be a separate entity from the business owner, their business. If you look at the slide that's down below, what we have is you have a captive insurance company, which is in the middle. You have the shareholders of the business. So the business has shareholders, and then those shareholders are the same one that own the captive insurance company. So the business pays premium to the captive, and the captive, when it distributes dividends, it goes to the owners, the shareholders of the captive, which are the same in 99 times out of 100 as the shareholders of the original business. The PATH Act was legislation that was issued in 2017. Before the PATH Act, the owners of the business and the owners of the captive could be two separate people. So in some circumstances, you had captive managers. Let's say you had a patriarch and matriarch that owned the business and they had children. Well, they would have the captive owned by a trust for their children. And what that enabled them to do is get money past the estate and gift tax line to their children. The IRS completely disagreed with this as a plan of intergenerational wealth transfer. When they passed the PATH Act says that the owners of the business and the owners of the captive have to be the same with regard to spouses and lineal descendants. And there was a 2% de minimis. So if a patriarch and matriarch own the business, their children could own at most 2% of the captive, but 98% of the captive had to be owned by the same shareholders. It was a quick one today. Thank you for tuning in. Now, we just republished our 2020 Ultimate Guide to Captive Insurance Companies. So if you put a comment down below and say you'd like a copy of this, then what we will do is we will send you a direct message with a link so you can download this. Once again, my name is Wes Sirk. I'm the president of Risk Management Advisors, a risk strategies company. Thank you for tuning in.